Hello, welcome back. So we have covered the sales budget, the production budget. We said we're skipping these three product cost budgets. We just covered the S&A budget in the last one. So now we're finally at the end of the operating budgets. Yay! It's the budgeted income statement. So let's talk a little bit more about that one. Budgeted income statement. Okay, so some facts about the budgeted income statement. It's the important end product, of the individual operating budgets, right? Because management is very interested to know what is their expected net income for the next year, right? Is that going to be reasonable? Maybe they have certain goals or certain objectives that they have to meet. So most managers, when they're looking at the operating budget, that's the one they care about, right? But of course, you have to go through all the other procedures and calculations in order to get there. So it's the important end product of all those individual operating budgets, sales, production, etc. It is going to show us, so it's going to be an income statement prepared with anticipated figures. So it's going to look just like an income statement. The only difference is they're not actuals, as we saw in 1A, where it was a historical, look back, what happened last year. Instead, it's looking forward. It's saying what we anticipate in the upcoming year. And what else was I going to say? Oh, in terms of the format, it follows the traditional income statement format. The one that we learned from Accounting 1A, or similar we just saw in the absorption lesson, right? So we're going to have the name of the company. It's going to say budgeted income statement. So we know we're not looking at an actual one, but a budgeted income statement. And just like the others, for the year ended, we'll say December 31st, 2020. Okay, so it's going to start with our sales, and we'll get that from our sales budget, right? And we could show this by quarter if we wanted to. Your book is just showing it at the end of the period at December 31st, so just the total figures. So that's why I don't have the columns here as I did in the other budgets. And then we know the traditional format after sales comes what? Cost of goods sold. Subtract that to get gross profit. From gross profit, you subtract your operating expenses, but we call those S&A expenses, selling and admin expenses. Right? It goes by many names: operating expenses, selling and admin expenses, non-manufacturing costs, period costs. But on the income statement traditional format, we'll see either operating expenses or S&A. All right, that gives us our income from operations. We subtract that. Here, I'll put little math signs in so you know what we're doing. Gives us income from operations, if you remember that from last semester. And then after that, we have our other revenue and our other expenses. The most common one that we're going to see in this chapter is we're going to have interest expense, and we'll have tax expense. Okay, so subtract both of those, and that gives you the company's net income. Yeah, I don't know if you remember that from 1A, where we had income from operations, and then we had other revenues and gains, other losses and expenses, and then net income. Now, sometimes you may have heard the term EBITA. I don't know if you guys have heard that before. Sometimes if you're in industry, you'll hear that term EBITDA. What's the EBITDA? What am I looking at? And so it means earnings before interest, because it's before we've considered our interest. So earnings before your interest expense, before your tax expense, and before your amortization. So that's what EBITDA means. If you've heard that before, I know my husband works in industry and that's a term they use, right? EBITDA. So just in case you've seen it before. That's what that is. All right, so that's our format for the budget income statement. The nice thing is you're really not doing any new calculations on the budget income statement. Everything is pulling. So the sales figure, that comes from your sales budget, right? So from sales budget. Cost of goods sold, if we had done it, it would have come from our DM, DL, and MO budget. So that cost times the units sold. Anything that's not sold, right? So if unsold, I think we hopefully all know if it's not sold, it goes to the balance sheet. So it would be your DM, DL, and MO cost times the unsold units goes to the balance sheet. So all your DM, DL costs go somewhere. It either goes to the income statement if you sold it, or it's on the balance sheet as inventory if you didn't sell it. Okay, so this is the difference. This came obviously from our S&A budget. So far you really haven't had to do much in the way of calculations. The most, just multiplying your cost that you already figured by the units sold at the most. Interest expense, this will be given. This you might have to calculate, right? They'll say in tax expense is 29% of your income. So you might have to do that. See, and that's why I like to have another subtotal here, but your book didn't show it. I like to do a separate total that says income before taxes, income before taxes. We'll see if we have to do that. It depends on how they give us this. But I like to do a separate one. It says income before taxes minus tax expense. But your book didn't have that subtotal, so I left it out. And then this, of course, is calculated. We just subtract your income from operations, subtract out your interest expense, and your tax expense. Okay, so we know our format. We know where everything's coming from. Again, it's pulling. You're not having to do too many new calculations because it's the end product. So all those calculations happened already earlier on in one of the earlier statements. All right, so go ahead and now pull up your outdoorsy data, and we're going to prepare their budgeted income statement. All right, see you later.